What if I told you that right now in today's housing market, opting for the affordable, government subsidized home actually forces you to buy a smaller apartment than if you just bought a luxury private condo?
Yeah, I mean, it sounds completely counterintuitive, right? But under the current financing frameworks, it is the absolute reality for a lot of families.
Huh.
The whole math of the property ladder has just been turned totally upside down
It really has. And if you've been eyeing that middle rung of the housing ladder, the executive condo, the rules of the game literally just fundamentally changed.
overnight, basically.
Right. So today we are taking a deep dive into this massive policy shockwave that hit the market on May 8th, 2026. Our mission is to figure out exactly what these new rules mean for you.
Yeah, there's a lot to unpack.
Definitely. We'll decode the four distinct options now facing public housing upgraders, dissect what that recent massive surge in developer sales actually tells us about buyer psychology, and look into the latest 18,000 flat home improvement program selection.
Which is huge.
Oh, massive. And finally, we'll build a comprehensive decision matrix for first-time buyers trying to navigate this wild new era. So let's just unpack this. We've always been told executive condos, or ECs, are the golden ticket.
Right, the guaranteed moneymaker.
Exactly. You buy at a discount, you wait a few years, it privatizes, and boom, you make a massive profit. But suddenly, this golden ticket comes with a really massive catch.
A very intentional catch, I would say. I mean, to understand where we are, we have to look at the behavior the government was actually observing right before that May 8th cutoff.
Okay, set the scene for us.
Well, for decades, the classic Singaporean pathway was super predictable. You start with a build-to-order flat from the HDB, right, your standard BPO.
Yep.
You live there, maybe move to a resale flat, then step up to an executive condo, which is built by a private developer, but subsidized and regulated by the government.
Right, the sandwich class option.
Exactly.
Yeah.
And eventually, you sell that and move into a fully private condo.
It was a very defined progression. You step on one rung, grab the next, pull yourself up.
But the data was showing that ECs were drifting really far from that original purpose. Like back in 2020, half of all EC buyers were genuine first-timers. But by 2024 and 2025,
Let me guess. It dropped.
it plummeted down to around 30 to 40%. And even more telling, 75% of ECs were being sold on the open market within 5 years of hitting their minimum occupation period, their MOP.
Oh, wow. Which means people weren't buying them to actually live in long term.
Not at all.
They were just using them as short to medium term investment products to flip for a quick profit.
Exactly. So the government stepped in to stop that behavior, and they basically pulled three major levers. First, the MOP for affected new ECs has literally doubled from 5 years to 10 years.
Wow.
And full privatization, which is that big milestone where you can finally sell the unit to foreigners or corporate entities, that now takes 15 years up from 10.
Wait, hold on. We really need to do the real world math on this because the timeline implications are massive.
Yeah, they are.
Because the MOP doesn't start the day you buy the place, right? It starts at TOP, the temporary occupation permit, which is when you actually collect your keys.
Right.
And it takes roughly, 3 to 4 years just to build the project?
Usually, yeah.
So if we add a 4-year build time to a 10-year minimum occupation period, I mean, the EC has gone from being this lucrative 5-year stepping stone to a 14-year marriage.
You are locked in.
Yeah.
I mean, if you sign the papers for a new rule EC today, you cannot exit that property until roughly 2039 or 2040.
That is insane to think about.
Right. And the second lever they pulled targets the financing mechanism directly. They completely removed the deferred payment scheme, or DPS.
Okay, so how does that actually change the buying process on the ground for, a normal buyer?
Well, under the old scheme, you could pay your booking fee and effectively pause the rest of your payments until the project was fully built.
Oh, nice.
Yeah, crucially, you didn't have to draw down your mortgage immediately. So this allowed an HDB upgrader to comfortably service their current flat's loan while they waited for the new EC to be constructed.
Right.
But with DPS gone, buyers are forced onto the standard progressive payment scheme. Your loan is drawn down in stages during construction, and your strict debt servicing limits are tested on the full loan amount from day one.
Oh, wow. Which demands much stronger immediate cash flow. I mean, that really cools the market by filtering out anyone who's maybe stretching themselves just a little too thin.
Exactly. And the third lever acts as a hard physical barrier for upgraders. 90% of units in new EC launches are now reserved strictly for first-timer families for the first 24 months.
90%.
90%. So second-timers, meaning current HDB owners who have already enjoyed a housing subsidy, they are forced to fight over a tiny 10% allocation for the first 2 years of a launch.
That is Brutal. So if the grandfathered ECs are going to be this bloodbath of competition, and the new rule ECs lock you in for a decade and a half while effectively shutting out current homeowners, what is the pressure release valve? Where do buyers go if they refuse to play that 14-year waiting game?
Well, we are seeing upgraders fracture into 4 distinct paths right now.
Uh-huh.
Path 1 is what the market is calling the final 5.
The final 5 sounds like a movie.
It really does. These are the 5 upcoming EC projects, places like Senja Close, Woodlands Drive 17, Sembawang Road, and Miltonia Close that were already in the pipeline before May 8th.
Ah, so they squeaked by.
Right. They're grandfathered under the old rules. 5-year MOP, the deferred payment scheme is allowed, and second-timers have normal access.
So those are literally the last golden tickets. The demand there is going to be incredibly intense.
Unprecedented. It's going to be a frenzy. Then Path 2 involves accepting the new rule ECs at sites like Canberra Drive and Sembawang Drive.
Oh.
Given the 90% quota and that 14-year lock-in we talked about, this path really only makes sense for genuine long-term owner-occupiers, specifically first-timers who know they want to stay in that exact neighborhood while their kids grow up.
Right. And path 3 is where I imagine the vast majority of frustrated upgraders are looking. They just, exit the public-private hybrid system entirely and pivot to the mass market private condos in the outside central region, the OCR.
Yes, that is the major shift. If you bypass the EC and buy private, you face 0 minimum occupation period, you get immediate rental flexibility, and there is no income ceiling.
So much more freedom.
Exactly. And your 4th option is to look backward to the resale EC market. You buy an older EC that has already cleared its 5-year MOP. You sacrifice the subsidized developer discount, obviously, but you completely avoid the new 10-year lock-in.
Okay, I want to circle back to the private condo pivot, though, because this is where the real aha moment of this deep dive lies for me.
Yeah, the math is wild.
It is. Intuitively, an executive condo is designed for the sandwich class.
Right.
It's supposed to be the affordable bridge between public housing and private luxury. But the financing rules actually flip that logic completely on its head.
They do.
Explain to me how a subsidized housing option ends up buying you less space than a really expensive private condo.
It is a fascinating paradox.
Yeah.
And it all comes down to how the government calculates your borrowing limit. Think of it like this for an EC, because it is still technically a subsidized public housing product at launch. The government forces you to use a very strict financial filter called the mortgage servicing ratio, or MSR.
Okay.
It's like a debit card with a hard daily spending limit. Your monthly mortgage simply cannot exceed 30% of your gross monthly income.
Wow, just 30%. Okay, let's run a scenario so you, the listener, can really feel the impact of this. Imagine a typical upgrader household earning a combined, say, $12,000 a month.
Sure. So under the strict 30% MSR cap for an EC, that family's maximum allowed monthly mortgage payment is exactly $3,600. Even with decent interest rates, a $3,600 monthly payment severely caps your total loan amount at roughly $750,000. So even assuming you have the cash on hand for a full 25% down payment, your absolute maximum purchase price is capped around $1 million.
And what does a $1 million budget actually get you in the EC market today? Let's use a recent benchmark like Revel Tampines, which averaged around $1,839 per square foot.
Yeah, so at $1,839 per square foot, a $1 million strict budget gets you a tiny 544 square foot unit.
Good grief.
That's a compact 2-bedroom at best, or maybe a 1-bedroom plus study. For an upgrader family moving out of a spacious 4-room HDB flat, that is a massive downgrade in living space.
But watch what happens if that exact same family, right, with the exact same $12,000 income, walks away from the EC and into a private condo showroom instead.
The rules completely change. For a private condo, that strict MSR debit card goes away. You fall into the total debt servicing ratio, or TDSR.
Yeah, the TDSR.
All right, this is more like a high-limit credit card. The TDSR allows up to 55% of your income to go toward debt obligations. Suddenly, your maximum allowed monthly mortgage leaps from $3,600 all the way to $600.
That is a staggering difference in borrowing power. Just massive.
It totally explodes your options.
Yeah.
That $6,600 monthly allowance translates to a potential purchase price of roughly $1.84 million, assuming you have the corresponding down payment.
So even though private mass market condos are significantly more expensive per square foot, let's say $2,111 per square foot compared to the EC's $1,839, that $1.84 million budget means you can suddenly afford an 871 square foot unit.
Exactly.
That's a comfortable 3-bedroom apartment. So the irony here is just mind-blowing. The strict 30% MSR cap on the quote-unquote affordable EC actively forces you into a smaller home, while the looser TDSR rules on the expensive private condo allow you to buy the space your family actually needs.
It perfectly illustrates how financing constraints often dictate product choice way more than the sticker price itself. And this paradox is exactly why we are seeing a massive wave of upgrader demand flowing directly into the private OCR market right now.
Which brings us to the April 2026 developer sales data. The numbers confirm this exact pivot, don't they?
The proof is absolutely in the transaction volume. In April 2026, the market hit a 6-month high with 1,548 new developer sales.
1,548.
Yeah. That is a 19% jump from the previous month and a staggering 129% increase year on year. What this data tells us is that buyer demand didn't just vanish when the EC rules changed. It is simply highly launch sensitive.
Right, they're just waiting.
Buyers are sitting on the equity built up in their HDB flats or scanning the private market and waiting for the exact right product to drop at the right price point.
And our sources highlight 2 specific case studies from April that perfectly map out the boundaries of this upgrader demand.
Yes, they do.
The first is Tenga Garden Residences. 855 units sold. That is a 99% take-up rate at an average of $2,111 per square foot. What drove that kind of absolute frenzy?
Tenga Garden Residences hits the exact mathematical sweet spot we just discussed. Tenga is this massive new eco-town with a really compelling future narrative, green corridor, proximity to the Jurong Innovation District.
The narrative is great.
It is, but the narrative is secondary to the math. The total quantum, the final price tag of the units, fits the typical HDB upgrader's TDSR borrowing limit perfectly.
Ah, I see.
Even without the MRT infrastructure fully built yet, upgraders will happily pay $2,100 per square foot because a 3-bedroom unit still lands in that manageable $1.8 to $2 million range.
It's the Goldilocks zone. Not too hot, not too cold.
Exactly.
But then you look at case study 2, Vela Bay at Bayshore. They sold 370 units, which is a respectable 72% take-up, but they did it at a record $2,865 per square foot for the East Corridor.
Right. Vela Bay represents the absolute ceiling of the mass market upgrader pool. When you push past $2,800 per square foot, a standard 3-bedroom unit rapidly approaches the $3 million mark.
That's a huge jump.
Massive. At that quantum, you are no longer competing with standard HDB upgraders. You are competing with dual-income no-kids couples, the dinks who have really high disposable incomes without childcare costs, and you're competing with seasoned investors.
So the actionable takeaway for you listening right now is pretty clear. If you are planning your upgrade, the optimal entry range for the mass market right now is a total quantum between $1.4 million and $2.2 million.
Spot on.
If a developer launches a project in that bracket, it flies off the shelf. If the price tag pushes higher, the air gets very thin, very fast.
But there is a catch to all of this OCR buying.
Oh, there's always a catch.
To afford that $1.8 million private condo, the vast majority of upgraders need to unlock the equity trapped in their current HDB flat they have to sell.
Which introduces a completely different variable. What happens if you are gearing up to sell and your HDB block is suddenly selected for the massive new home improvement program? Because that throws a major wrench into the timeline.
It really does. The Home Improvement Program, or HIP, is disrupting a lot of sales timelines right now. The government recently announced that over 18,000 flats, specifically blocks built up to 1997, were selected for upgrading, backed by a $253 million budget.
That's a huge scale.
Yeah. The contractors come in to replace aging pipes, upgrade electrical wiring, and waterproof the bathrooms. The financial hook is that it is heavily subsidized. For a standard 4-room flat, the owner share for the full optional package is just $899.25.
Less than $900 for essentially a brand new plumbing and electrical nervous system for your house. I mean, it's an incredible deal for the homeowner, but it creates a massive strategic dilemma if your goal was to sell the flat this year.
Right, because you are faced with 2 less than ideal choices. You can sell before the HIP begins. The benefit is you avoid 6 to 12 months of intense construction disruption, the drilling noise, the dust, the hassle of using temporary toilets in your void deck.
Yeah, nobody wants to live through that if they don't have to.
Exactly. But the downside is you miss out on the price premium of handing over a freshly upgraded flat to your buyer.
Or you grit your teeth, you live through the construction, and you sell after HIP is completed.
Yep, the second option.
You get to market the flat with brand new wiring, fresh pipes, pristine bathrooms, which obviously appeals to buyers. You can often command a higher asking price. And I always push back when sellers get overly excited about HIP premiums. Does a new pipe really change the fundamental value of a 40-year-old building?
It's a fair question.
I always tell people HIP is like putting a brand new engine in a classic car. It drives better, it looks much nicer on the inside, but it doesn't magically reset the odometer.
That is the perfect way to look at it,
Oh,
and it really highlights the harsh reality of Bala's curve.
oh, right. Bala's curve. Remind us how that works.
It's the geometric curve that maps the declining value of a leasehold property. A 40-year-old flat with a shiny new bathroom is fundamentally still a 40-year-old flat sitting on a decaying 99-year lease.
Right.
When your potential buyer goes to the bank to secure their mortgage, the bank's valuation algorithms and their loan-to-value limits will strictly follow that decaying lease schedule. The bank cares entirely about the remaining years on the land, not the new tiles in your shower.
Right. So the advice is definitely factor the HIP upgrades into your marketing strategy to make the flat more attractive, but don't expect it to magically erase the age of your property when it comes to the final bank valuation.
Exactly. Manage those expectations.
Okay, we've spent a lot of time focusing heavily on the upgraders trying to navigate the complex middle rungs of this ladder. But what about the person looking at the very first rung? Let's zoom out and build a decision framework for the first-time buyer trying to enter public housing today.
This is critical. For first-timers, the landscape is now defined by a new flat classification system, giving you 4 distinct starting points, and each comes with very different long-term consequences.
Let's break them down.
The first is the standard BTO. This is your traditional route, a standard 5-year minimum occupation period paired with a 3 to 5-year wait for construction to finish. It is ideal for young couples willing to wait for a fresh flat who really prioritize the flexibility to upgrade and move in their early 30s.
The classic starting line.
Right. Then you step up to the plus BTO.
Okay, what makes it plus?
Plus BTOs offer better, more central locations, usually closer to MRT stations and amenities. But they come with a significant trade-off, a 10-year MOP and a subsidy clawback.
Ouch.
Yeah, this means when you eventually sell the flat on the open market, you must return a percentage of the initial subsidy back to the government.
Okay, then you have the prime BTO. These are the crown jewels of public housing prime city locations with the absolute highest subsidies. But the government attaches the strictest rules imaginable to them.
Very strict. Prime flats carry a 10-year MOP, a heavy subsidy clawback, and unique restrictions that extend to the resale market.
Like what?
Well, for instance, there are strict income ceilings imposed on future buyers who want to purchase your prime flat down the line.
Wow, so you can't just sell to the highest bidder.
Exactly. Furthermore, you are never allowed to rent out the whole flat, even after the MOP is over.
Which severely limits your potential buyer pool and your rental yield if you ever decide to move out. And your fourth option is bypassing the build time entirely and just buying a resale HDB flat.
Yeah, the resale market gives you immediate occupancy and a standard 5-year MOP. The trade-off, of course, is the cost. Even with generous government grants, buying resale requires significantly higher upfront cash compared to a BTO.
So standard plus, prime, or resale. When you lay it out like that, what is the hidden trap that first-timers need to be hyper-aware of?
The timeline trap. The cascading implications of a 10-year MOP on plus and prime flats are profound for your life milestones. Let's map it out. Imagine a young couple applies for a prime BTO at age 25.
Okay, pretty typical.
Best case scenario, it takes 5 years to build. They collect their keys at age 30. Then they must live in it for a mandatory 10 years. They will be 40 years old before they are legally allowed to sell that flat and even begin the private property upgrade journey.
Wow. By the time they can finally unlock that equity, they might have teenagers. It completely shifts the timeline of asset progression. You aren't casually flipping a flat in your late 20s to fund a condo anymore.
Not at all.
When you choose a prime or plus flat, you are committing to a neighborhood for a massive chunk of your adult life.
And that is the exact behavioral shift the policy is designed to create. The government is intentionally engineering a system that deeply rewards genuine, long-term community living while systematically penalizing short-term speculation.
Okay, let's bring all these threads together. The property ladder in Singapore isn't broken, but the rungs have been spaced much, much further apart.
That's a great way to put it.
Executive condos are no longer a quick, lucrative 5-year flip. They are a 14-year commitment that demands rigorous, immediate cash flow. And because of that structural change, the mass market private condos in the OCR are absorbing a massive wave of upgrader demand.
Yep, the data proves it.
But as we saw with the MSR versus TDSR debit and credit card math, entering that private market requires some incredibly precise financial planning to ensure you don't actually compromise on living space.
It's all about the hidden math.
Exactly. And if you're a first-timer staring at the new BTO classifications, you need to be planning a full decade ahead, not just looking at your needs for the next 3 years.
The era of easy, automatic asset progression is decisively over. Every single step on this new ladder requires strategic foresight, a deep understanding of the financing mechanisms at play, and just a clear-eyed, realistic view of your own long-term lifestyle needs.
Which leaves us with a final provocative thought for you to ponder. We've spent the last 20 years culturally obsessed with this idea of asset progression. You know, buying to upgrade, upgrading to sell, always looking over the fence at the next rung.
Always climbing.
Right. But when you look at the new 10-year lock-ins on Plus and Prime BTOs and the grueling 15-year privatization timeline for executive condos, are we finally witnessing the deliberate death of the stepping stone property? Is the market being quietly engineered so that your first home is actually meant to be your forever home?
It really makes you wonder.
It does. If that ladder suddenly vanishes, maybe it's time we start getting comfortable right where we are standing. Thank you for joining this deep dive into your customized sources. Keep exploring, keep questioning, and we'll catch you on the next one.